Guys, there are a few questions that I'm very proud of that I've compiled over the past 4 years since I've been at the varsity. And I think Bimbo must be my number one on the list. That is the cherry on the cake. And the creative juices were definitely flowing when I compiled Bimbo. And definitely, I will, you can expect something like that because Bimbo really tests whether you understand the work that we've done up to now from the other side, the other way around. So it's very important that you are able to understand exactly what to do in order to solve this problem. Bimbo sells and distributes a wide range of packaging materials to fast food retailers in Gauteng. Bimbo's accountant suffers from attention deficit syndrome, and she completed a statement of financial position and the statement of cash flow for the year ended 31 March 2017. However, she battles to complete the statement of profit or loss and other comprehensive income and is now so confused about what she has to do next that she requested you to assist her in the finalization of the statement of profit or loss and other comprehensive income. She gives you the following statements and you can assume that all the figures are correct. They give you the financial statement as at 31 March 2017. Non-current assets consisting of PPE and investments. Current assets, inventory, trade receivables and bank. Total assets, equity, stated capital, so that's no par value ordinary shares. Revaluation surplus, retained earnings, non-current liabilities, long-term loan, trade payables, and then total equity and reserves and liabilities. Statement of cash flow now. They give us the cash flow from operating activities, cash receipts from customers, cash paid to suppliers and employees, cash generated from operations, and then we have dividends received, interest paid, dividends paid, and taxation paid. Net cash from operating activities was the 757,868. Cash flow from investing activities, purchase of machinery, proceeds on the sale of machinery, proceeds on the sale of an investment, net cash from investing activities, cash flow from financing activities, proceeds from the share issue and repayment of a long-term loan, and then the movements in our cash was a positive 742,000 rand. Then they give me some additional information on property, plant and equipment. They give us a depreciation policy. They tell us that some of this machinery was actually sold in the year, and then the depreciation, they tell us, must be classified as other expenses in the statement of profit or loss. Then they carry on and they give us an extract of the property, plant and equipment, a little bit more information. During the year, it was discovered that some of the inventory was obsolete and the net realizable value, which is also classified as other operating expenses of 38,000 Rand, was made. So it's already in the books. It's important to note that the cash flow statement and the statement of financial position are final figures. There's no adjustment entries that you have to pass. All sales are on credit. Where do we account for credit sales, guys? In the debtors account. And Bimbo has a policy to grant 30 days credit to all customers. The reason for this is to prevent the delivery staff from handing cash receipts. During the year, credit losses classified as administration expenses amounting to 103,000 Rand was written off. The gross profit percentage on the selling price equals 40%. Trade payables relate only to the purchases of inventory. Expenses, excluding those specifically mentioned above, like the credit losses, which is an admin, like NRV, which is other operating expenses, all the other expenses can be allocated in the ratio 50 to 30 to 20, being distribution, admin, and other expenses respectively. Now in the required part, the A part, they want you the statement of profit or loss and other comprehensive income, and the B part, they want you to do the reconciliation note of profit before tax with cash generated from operations. Now in this question, guys, I did actually give you an A and a B part just to lead you in the question. Otherwise, I don't think many of you would have had the savvy to come to some kind of conclusion. Actually, what you have to do is you have to do the reconciliation note first. So let's do the reconciliation note, and then you will see why do we have to do it first. Now, in that reconciliation note, you do reconcile cash generated from operations, that 1736250, to what amount? To your profit before tax amount. So you start with profit before tax, and then you work towards this figure, cash generated from operations. Now we're going to do exactly now, the same thing now. We're going to start at the profit before tax note, which we don't know what it is. So that is going to be our balancing figure, and we're going to end up with cash generated from operations 1736250. That is the amount that they gave us. Now, what do we adjust profit before tax to? We adjust that for non-cash flow items and separately disclosable items. Not true. So let's see what we can gather out of this question. What is non-cash flow and what is separately disclosable items? And you know that depreciation is usually the first one that we're going to calculate, and we do that out of the PPE note. Great. They give us a breakdown of property, plant and equipment. They tell us property, plant and equipment consists of the following. Now, the first one is land and buildings. And there we have a revaluation surplus. And that revaluation surplus increased with 300,000 Rand in the current year. If we go down to this extract of PPE, you see here that our land and buildings have also increased with 300,000 Rand for the year. So therefore, with no further ado and without any further information on land and buildings, we can now assume that that increase in the value was as a result of other comprehensive income. Now, the A part wants you to do the statement of profit or loss and other comprehensive income. And you could have put down your template for that already, because you know what it looks like. You know what a statement, an income statement according to IS1 looks like. And immediately, once you have seen this, you can put on your answer here, as part of other comprehensive income, profit on the revaluation of land, 300,000 Rand. Let's have a look at machinery. Now, we have to do the income statement. So we are not really worried about the cost price of machinery. Why not? Because the cost price of the machinery, any new machinery that we've acquired or sold, is actually not going to the income statement. But the accumulated depreciation account has the income statement item in it, and that being depreciation. So if we go to the question and they tell us that the accumulated depreciation on machinery had an opening balance of 260,000 and a closing balance of 253,000 Rand. 260, 253. They also told us here in the additional information that the depreciation policy of the company states that depreciation of machinery and equipment is 10% per annum on the straight line basis. Depreciation on the delivery truck is 20% per annum on the reducing balance method. Management decided not to take into account any estimated residual values on any of those assets. Then it tells us that machinery with a cost price of 120,000 and accumulated depreciation of 39,000 was disposed of. Now, that means that we can remove that out of the accumulated depreciation. The realization account was 39,000, so therefore we can take it out. Now we have the opening balance, we have the closing balance, we have the realization account, and then the balancing figure must be our depreciation on machinery for the year of 32,000 Rand. There it is, 32,000 Rand. What did we actually calculate it in the realization account? The profit or loss on the realization or the selling of this asset, the disposal of the asset. The cost price of the asset sold was 120,000. The accumulated depreciation on the assets sold was 39,000. And where do we account for the proceeds on the sale of machinery? In the cash flow statement. So therefore that one was 85,000 Rand. So in our asset realization account, proceeds 85,000, profit on disposal 4,000 Rand. What is profit on disposal? Profit on disposal, guys, is a non-cash flow item. So if we go back to our calculation here, our reconciliation note, profit on the sale of the machinery, 4,000 Rand, non-cash flow, we would have taken it off. At this point of time, we don't have that, but we know that that actually increased our profits before tax. So therefore, if you want to take it out, I have to deduct it. Profit on the loss. Now, the whole story about vehicles. They gave us a vehicle, and you can see clearly here that there was no movement in the cost price of vehicles over the 2 years. So therefore, it's safe to assume that the difference in the accumulated depreciation from the 1 year to the next year can only be representative of the depreciation that we've written off on the delivery vehicle. So if we go now to our depreciation here, we said the depreciation charge on the vehicles was 80,000 Rand. So total depreciation is now the 32,000 plus the 80,000, which will give you 112,000 Rand. So again, as a non-cash flow item, we would have added back depreciation in total 112,000 Rand. Now, going back, that is property, plant and equipment, but I don't know whether you've noticed, you should have noticed, that there was also a change in the value of our investment. You can clearly see that there was a reduction of 25,000 Rand in the investments that we have. Now, if we go to the cash flow statement, we see that the proceeds on the sale of investment was 30,000. Now, if the cost price of the investment sold was 25,000, as we've seen here, that means that we must have made a profit on the sale of investments of 5,000. And what do we do with that profit? That's also a non-cash flow item, so that we're also going to reduce our profit before tax with. Now, the rest of the items they gave you, they told you that there was a net realizable value adjustment of 38,000 Rand, which is part of other operating expenses. So that 38,000 is a non-cash flow item, so we have to add it back to our profits. Furthermore, they gave you all the sales, it's not that one. Somewhere they told us about the credit losses. Credit losses written off for the year, also an admin expense, was 103,000 Rand, a non-cash flow item, which we're going to add back to our profit before tax. Now, if we go further back to your statement of financial position, there's nothing about dividends payable or anything like that. Somewhere in the question, though, they tell you that trade payables only consist out of trade creditors. So there's nothing like shareholders for dividends or income tax payable, something like that, because they tell you here that trade payables relate only to the purchases of inventory items. Great. So therefore, the amounts that we indicate in our cash flow statement as interest paid must equal our finance cost for the year. And interest paid is also a separately disclosable item. So therefore, that 20,000 Rand If you go to your income statement where you have to show your finance charges separately, you can go say financing cost minus 20,000 Rand. In your cash flow statement, that is a separately disclosable item, so interest paid or interest expense, 20,000 Rand. Dividends received. Again, there's nowhere dividends receivable. That 1,500 Rand would also have been part of your separately disclosable items. So dividends received, you would have taken out of your profit before tax because it's a separately disclosable item. Now you've dealt with all your separately disclosable items and non-cash flow items. Working capital changes, that's the next thing that you have to adjust your profit before tax with. So what is the first one? The movement in inventory balances. I have the statement of financial position, so I can work it out. Inventory is the difference. There's a reduction of 189 to 146, but remember, we have written off an NRV adjustment of 38,000 Rand. So therefore, the movement in inventory will be our closing inventory of 146,000 plus the NRV adjustment minus last year's balance of 189,000. So that would have given us 5,000 Rand. Movement in trade payables. Now that is purely the difference between last year's balance and this year's balance. So 190. 204, it's an increase, so therefore it is an inflow of cash of, there it is, 13,900. Trade receivables. Now you must watch out again because there was credit losses written off. So that would have been 220,000 plus the credit losses written off of 103,000 minus last year's balance of trade receivables of 290,000. So there was an increase in trade receivables. So that's an outflow of cash of 33,000 Rand. So our total working capital changes was 14,100. And now I can work backwards. I'm going to start now with a 1376250 and I'm going to add backwards and then I'm going to determine as a balancing figure what was our profit before tax for the year. Guys, it's actually simple common sense. But if you don't understand what the reconciliation note is all about, if you don't understand the reasoning behind the reconciliation note, I think you would have battled quite a lot in order to derive at this figure of 1487850. So now we have that figure and we can go to our income statement and we can actually populate it in our income statement. There it is, profit before tax, 1487850. Out of our cash flow statement, we have also seen here as a separately disclosable item, taxation paid, 1479882. Because our tax payables is only something to do with inventory, it's got nothing to do with the receipt of revenue, and trade receivables are purely, note number 3, debtors. So therefore, the taxation that we paid in our cash flow statement, that 479,882, must have been equal to our expense for the year as well, 479,882. So we have the 1,487, now we have the 479, so profit for the period obviously will be the difference between the two. We have the profit on the revaluation of land of 300,000, so we have our total comprehensive income for the year, 1,307,968. Now we have to work backwards. We only have the bottom part of the income statement now. In what note to the cash flow statement does revenue or sales appear? Revenue or sales is being used in order to calculate cash received from customers. that 4717. And how do we calculate cash received from customers? We take our revenue figure and then we adjust that for the movement in our debtors balance. So they tell us here, all sales are on credit and Bimbo has a policy to grant 30 days credit to all customers. The reason for this is to prevent the delivery, and there was then the credit losses of 103,000 rand. So let's do that calculation then. We say, well, our sales is going to be our balancing figure in our debtors account. For debtors, we have our opening balance of 290,000 rand. Opening balance 290,000, closing balance 220,000. They told us that we've written off credit losses of 103,000 rand. They also told us in our cash flow statement that all sales are on credit. Therefore, the cash received from customers are all from outstanding debtors. And in our cash flow statement, we do have that figure. And the cash received from customers was 4717,000. So then in our debtors account, we can actually put in bank 4717,000. If you've done the alternative, you would have said cash received from customers, which is given 4714,000. Right here, given. And then we would have said, okay, well, now what is the movement in debtors? Now the movement in debtors we've already said is the 220,000 plus the 103,000 less the 290,000. So that gives us then 33,000. It's an increase in debtors, so therefore it's an outflow of cash. So then if I work backwards, my sales is going to be the balancing figure of 4750,000. If I went the T account route, we had the opening balance, we had the closing balance, we had the credit losses written off, and we had amounts received from debtors. So then our balancing figure would have been our sales account, 4750. And that is the first figure that we're looking for in our statement of profit or loss, revenue, 4750,000. Then cost of sales. Now, if we went back to that number 3 there, the gross profit percentage on the selling price is 40%. So I can calculate my gross profit. My gross profit being then 40% of my sales figure. Oops, I do the same what you do in your test, and then you add a 0 or you work omit a 0, and that is just one big mess. Don't do that. Write your figures properly. After every 3 there's a space. You were taught this, I think, in nursery school already. So if I take 4750 times 40% gives me 1.9 million, and that equals my gross profit. Good. I have a line item, other operating income. And as a matter of fact, I have already identified here when we did this reconciliation note, a few items which will be form part of other operating income, like the profit on the sale of machinery, 4,000 rand. The profit on the sale of investments, 5,000 rand. And dividends received, if I did not put it on a separate line, but it's a small amount, 1,500 rand. So other operating income are those 3 figures together, 10,500 rand. If I did put my dividends received as investment income, I could have added the 1,500 rand there, and then it would not have been included in this figure of other operating income. So my other operating income would then only have been 9,000 rand. Both of them would have been correct. So now I've got 10,500 rand. I've already inserted my financing costs. So the three outstanding items are now those three: distribution costs, administrative expenses, and other expenses. The question tells me that over and above a few items which they gave me, I have to do that allocation between distribution, administration, and other in the ratio of 50-30-20. So let's put down these three headings and let's populate under them those items which I already have. They tell me depreciation charges of machinery and equipment is classified as other expenses. Now we have already calculated the depreciation on machinery, and that was 32,000. The machinery of the depreciation on delivery vehicles, which obviously is distribution and selling, is 80,000. So if I have selling, distribution, administration, and other, we're going to say depreciation is 80,000 under selling and distribution, that's a delivery vehicle, and 32,000 under other, that's where they tell you that you have to park that. So in total, that gives us 112,000 rand. Then the question went on and said the NRV adjustment, that's an expense, that must be classified as other operating expenses. So we do that now. So that expense under other operating expenses, this was a write-off of inventory items, and it was not done in the cost of sales. It must be then in other. So NRV adjustment under other, 38,000 rand. Then the question went on and says credit losses is an admin expense, and that was 103,000 rand. So under admin, credit losses, 103,000 rand. Now going back to your income statement, I have my profit before tax, and I have those. I actually have those two figures, and I have these two figures. So I know what the total of this must be. So 1.9 plus 10,500 less X less 20,000 equals 1487950. Gross profit 1.9 million plus the 10,500 less the financing charges. Now, less the charges which I already have accounted for, because that's also part of that. And what was that? That was the 38,000 for the NRV adjustment, that's 38,000. It was the credit losses of 103,000. It was the depreciation in total of 112,000, less the profit before tax is the unaccountable or unaccounted expenses which we haven't dealt with as yet. And that is an amount of 149,650. And that amount must be distributed in the ratio of 50, 30, and 20. So 50% of 149,650, 74,000, 30% of that amount being 44,895, and 20% of that amount being 149,650. So guys, once we have that in place, now we can add total selling, total admin, and total other. And once we've added that, we can insert those totals in our statement of profit and loss. There's the 154 distribution costs. There's the 147,895, which is admin expenses, and there's the 99,930, which actually is other operating expenses. And now if I do my calculation, I would say 1.9 plus 10.5 minus 154, 147, 99, and 20. That gives us profit before tax, and the puzzle is completed. Guys, it's not that difficult, but you have to understand exactly what am I busy with. What does a statement of what story does a statement of financial position tells me? What story does a cash flow statement tells me? And you have to know exactly how do I calculate the underlying figures, which actually at the end of the day ends up in a statement of cash flow or ends up in a statement of financial position. Please go back and do this question again, and please see if your reasoning can actually explain the rationale behind the story.